The day liquidity disappeared. It didn't vanish gradually. It wasn't withdrawn politely. One moment the market felt deep, active, and responsive. The next, it fell hollow. Orders went unanswered. Prices jumped without warning. And suddenly, the thing everyone assumed would always be there, liquidity, was gone. To understand why this moment still matters, we have to revisit how modern markets learned to depend on continuous motion. Liquidity became something taken for granted, like electricity in a city. As long as the system stayed on, no one questioned where it came from or what might happen if it failed. Buyers assumed sellers would appear. Sellers assumed buyers would step in. And the space between them felt permanently filled. But liquidity is not a substance. It is behavior. It exists only when participants are willing to act. And that willingness rests on confidence. Confidence that prices are fair, that exits exist, and that others will behave predictably. The moment any of those assumptions falter, liquidity doesn't thin. It evaporates. The early signs were easy to misread. Bid-ask spreads widened slightly. Transactions slowed. Traders blamed technical issues or temporary caution. After all, volatility had spiked before and markets had recovered. The belief that liquidity was resilient remained intact, reinforced by years of experience where stress was brief and recoveries were fast. What few noticed was that the structure beneath the market had changed. Liquidity was no longer anchored by long-term participants willing to absorb shocks. It was increasingly supplied by actors who depended on speed, algorithms, and continuous confidence. As long as conditions remained normal, this worked beautifully. But normality was a requirement, not a guarantee. The reveal began when selling met silence. Orders entered the system and found no counterpart. Prices adjusted sharply, not because value had changed, but because participation had withdrawn. The market wasn't discovering price anymore. It was searching for anyone willing to trade. In that moment, a dangerous realization spread. Liquidity had not failed because assets were toxic. It failed because uncertainty made waiting safer than acting. And when too many participants choose to wait, the market stops functioning as a market at all. The day liquidity disappeared was not marked by a single headline. It was marked by absence. Absence of bids. Absence of trust. Absence of the invisible agreement that allows markets to move smoothly. And once that agreement breaks, recovery becomes far harder than anyone expects. As liquidity retreated, confusion replaced confidence almost instantly. Participants scanned their screens, refreshing prices that no longer felt real. Quotes flickered, widened, then vanished. What had once been a constant stream of transactions slowed to a trickle, then an isolated burst of activity that felt disconnected and erratic. Institutions reacted defensively. Market makers pulled back, unwilling to commit capital when price signals no longer made sense. Funds reduced exposure, not because they understood the risk, but because they could no longer measure it. When valuation becomes uncertain, preservation takes priority over opportunity. And preservation, when practiced collectively, drains the system of motion. The withdrawal fed on itself. With fewer participants willing to trade, price movements grew sharper. Sharp movements confirmed fear. Fear justified withdrawal. The loop tightened with every minute. Liquidity wasn't just leaving. It was being chased out by the logic of self-protection. What made this phase especially dangerous was how unfamiliar it felt. Models still showed adequate capital. Balance sheets still looked strong. But none of that mattered when no one wanted to be first to act. Liquidity does not respond to strength alone. It responds to shared belief. And that belief was fragmenting in real time. Clearing systems strained under irregular flow. Trades failed to settle on expected timelines. Collateral values shifted faster than margin systems could adjust. Each delay amplified uncertainty, convincing participants that stepping back was safer than stepping in. The market was no longer a place of exchange. It had become a place of hesitation. Outside the trading floors, the impact spread quickly. Funds gated withdrawals. Credit lines tightened. Institutions that depended on continuous market access found themselves exposed to a risk they had never modeled. The risk that markets would simply stop cooperating. The reveal deepened. Liquidity was not guaranteed by regulation, technology, or size. It was sustained by trust and continuity. And once continuity breaks, even briefly, the memory of that break changes behavior long after conditions improve. This was the early conflict taking full shape. Not a collapse, but a paralysis. Not destruction, but withdrawal. The system was still standing, but it was no longer moving as expected. And when motion disappears from a system designed around speed, pressure begins to build in dangerous places. The paralysis spread faster than anyone anticipated. Markets that had been loosely connected suddenly moved as one, not through coordination, but through shared hesitation. If liquidity could disappear here, it could disappear anywhere. And that realization changed behavior everywhere at once. Institutions hoarded cash, not because they needed it immediately, but because they feared needing it when no one else would provide it. Credit markets tightened sharply. Short-term funding, once routine, became suspect. Lenders demanded higher margins or refused entirely. Borrowers scrambled, not to invest, but to survive. The stress revealed itself in unexpected places. Assets previously considered safe became difficult to trade. Price discovery broke down. Valuations diverged wildly depending on who was forced to sell and who could afford to wait. The market was no longer pricing risk. It was pricing urgency. As pressure mounted, structural weaknesses surfaced. Funding mismatches that had seemed manageable under normal conditions became critical. Institutions reliant on rolling short-term financing faced immediate strain. Even those with strong long-term assets struggled, not because of insolvency, but because of timing. Liquidity had disappeared precisely when it was most needed. Human response lagged behind market speed. Committees convened too late. Approvals arrived after conditions had shifted. Communication failed to keep pace with fear. By the time reassurance reached participants, they had already adjusted their behavior toward caution. This was the emotional peak. Not panic in volume, but panic in restraint. Everyone understood that the system could not function if no one was willing to move first. Yet no one wanted to be exposed while uncertainty dominated. The conflict reached its core. Liquidity was never promised. It was a coordination problem, and coordination had broken down. Each participant acted rationally in isolation. Collectively, those actions created dysfunction. The buildup had exhausted itself. Markets could not remain frozen indefinitely. Something had to change. Either confidence would return or intervention would impose motion from outside the system. The question was no longer theoretical. It was immediate, and the answer was coming. The shift came not from the market itself, but from outside it. When coordination failed completely, authority stepped into forced motion where trust could not. Emergency facilities were opened. Guarantees were announced. Liquidity was injected not as an incentive, but as a signal that hesitation would no longer be rewarded. The climax was not dramatic. It was structural. By removing uncertainty about access to funding, intervention changed incentives. Participants no longer feared being the only ones exposed. Markets did not immediately normalize, but they began to function again. Bids reappeared. Spreads narrowed. Prices, while volatile, started to make sense. What this moment revealed was uncomfortable but undeniable. Liquidity does not return because assets are valuable. It returns because participants believe others will act as well. Confidence was not restored by reassurance alone. It was restored by coordination imposed when voluntary cooperation failed. The resolution unfolded gradually. Trading resumed. Credit reopened selectively. Institutions adjusted their expectations, now aware that liquidity was conditional, not continuous. The memory of disappearance lingered, altering behavior long after the immediate stress passed. The deeper lesson endured. Markets are not machines that run independently once built. They are agreements, fragile, behavioral, and depend on shared belief. When that belief fractures, even briefly, the system requires more than capital to recover. It requires alignment. Liquidity did not disappear because the system was weak. It disappeared because coordination broke down under speed and uncertainty. And once participants experienced that absence, they could never fully forget it. This was the day markets learned that motion cannot be assumed. It must be protected, supported, and sometimes enforced. So, what do you think? Are we repeating the same mistake again? The day